Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And boy, do we have a redemption on our hands today. Today we're diving into a recent filing from Great Elm Capital Corp, or GECC as they're known. This isn't your typical quarterly report offering a deep dive into their earnings. Instead, GECC is issuing notices about redeeming some big chunks of their debt, specifically their 8.75% notes due in 2028. This might sound a little dry, but trust me, there's a story here about how they're trying to tidy up their finances, and it all hinges on a potential financing deal working out. Make sure you are subscribed and join our Discord community linked in the description below for more insights like this. So what's going on? GECC is calling back a significant portion of their debt. They're planning to redeem $30 million worth of these 8.75% notes on September 30th. Think of it like paying off a big loan early. This is their first redemption notice. But there's a twist. They're also hinting at redeeming another $10 million of the same notes on the same September 30th date. Now, this second redemption is conditional. It's like saying we'll pay you back this extra bit if we can get new money in the door. They need to raise at least $10 million through new financing before that second redemption date. If they don't get that new money in, or if the new money comes in late, they have a few options. They can push back the redemption date for that extra $10 million, or they might just cancel that part of the redemption altogether. It's a bit of an if-then scenario. The key takeaway here is that GECC wants to pay down its debt, and it's looking to do so by refinancing or securing new funds. When they redeem, these notes holders will get back the original amount they lent out, plus any interest that's built up until the redemption day. The interest on these notes is paid every 3 months, with the next payment due on that redemption date, September 30th. They're saying they don't expect there to be any unpaid interest on that date because the next interest payment is right on the redemption date. However, if someone buys these notes right before the redemption date and after a certain record date for the interest payment, they might not get that last bit of interest unless that second conditional redemption goes through and gets delayed. It's a detail, but it's about making sure the interest accounting is clean before the debt is gone. This filing also gives us a snapshot of what GCC has listed on the stock exchange. We see their common stock traded under the symbol GECC, and then various notes like the 5.875% notes due 2026 traded as GECCZ and so on. This tells us what the market sees as their main financial instruments. The core of this report is really in the attached notices. These documents spell out the exact terms of the redemption for the bondholders. They clearly outline the amounts, the dates, and the conditions. It's the official communication that triggers the repayment process. And as is standard practice for these filings, the report is formatted in XBRL, which is basically a digital language for financial reporting, making it easier for computers to read and analyze this data. It also includes the standard sign-off from their Chief Financial Officer, Kerry A. Davis, confirming the accuracy of the report. Now let's talk about what this all means. GCC is actively managing its debt. They're not just letting it sit there, they're making moves to pay it down. The redemption of their 8.75% notes specifically, and the conditional redemption of an additional $10 million show a clear strategy to reduce their outstanding debt obligations. This often happens when a company believes it has a better way to finance its operations, or when it wants to improve its financial flexibility. The fact that the second redemption is tied to future financing means they are likely confident they can secure that new capital. If they can execute this, it strengthens their balance sheet, reducing their interest expenses and possibly making them more attracted to investors or lenders in the future. However, the big risk here is that the financing doesn't happen. If they can't secure that $10 million or more, then that second chunk of debt won't be redeemed as planned potentially, leaving them with a higher interest burden than they anticipated for that portion. It's a calculated move. They're betting on their ability to raise funds. Looking at the broader context, Great Elm Capital Corp operates in the financial services sector, often acting as a business development company, or BDC, which means they invest in and lend to small and medium-sized businesses. Companies like this can be sensitive to interest rate changes and economic conditions. Proactive debt management is usually a sign of a healthy and forward-thinking management team. They are essentially trying to refinance at potentially better terms, or simply reduce their overall debt load to boost profitability and financial stability terms. Or simply reduce their overall debt load to boost profitability and financial stability. What's notable here is the proactive nature of this debt reduction. By calling back these notes, GECC is taking control of its financial future. If they successfully raise new funds and complete both redemptions, this will be a positive step indicating financial discipline and strategic planning. It suggests they see opportunities or have a clear path to strengthening their capital structure. This is the kind of move that can lead to better credit ratings and lower borrowing costs down the line. To wrap up, Great Elm Capital Corp is making the strategic move to slash its debt, which is generally a good sign of financial health and proactive management. The success of this plan hinges on their ability to secure new financing for a portion of the redemption. If they pull it off, it's a win for their financial stability. If not, they have to reassess their strategy. Keep an eye on their next filings to see if they successfully gather that new capital. What's your take on these debt redemption plans? Do you think GEC can pull off the financing? Let us know in the comments below, hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord channel, linked in the description, to keep the conversation going. Thanks for watching and we'll see you in the next video.